So on STMP, I've got it in 3 different accounts. I think I have 300 in another account and 250 in one account, and this is my big swing trade account. I've got 6,675 in this account. My only regret was not buying more at $37. Obviously I profited nice $2,800 here, and from 510 I kept looking at it. I started buying more, and I just pulled the trigger today after I had confirmation on a trend upward, and I bought an additional 2,900 shares. So I'm in it for total position right now. My current position is 289,000, which I'm showing $13,472 profit in this position alone. The reason I wanted to share this is I put my money where my mouth is, and I obviously I feel strongly about this stock in order to go out on a limb and take some margin out and make it go. So you see that just changed my P&L. Total P&L for this stock is 14,000. Obviously I have my stop losses set, so if this P&L gets down to I think 5,700, I'll be out, I'll cash, and I'll still be up 5,700 for I think a 2 point something percent. But I set my my stop loss far away from it because I don't want to get stopped out. I think overall it's going to continue to trend up to the market analyst prediction price of just a little bit over $93 a share. I'll be taking profits along the way, and anyway, I'm going to talk about the stock now. Okay, Gabe, you're a go. All right, that's a go to myself. I want to talk a little bit about my swing trade that I'm going long in on STMP, which is stamps. They offer a subscription-based service to companies. You can basically print out all your shipping labels and place them on the package, and just either put them out front and have the carriers pick them up or drop them off. No more waiting in line. What's unique about this is the extreme low overhead with high gross profit margins. Basically, it there is very little overhead, capital expenditures, and people actually print out their labels and then place them and fix them on their own packages and go out. So what they do is they take a cut of that. They negotiated terms with the postal service, so reduce fees. So businesses like them. It was a great business for the last few years. It kept trending up and up and up. And it in June 2018, it actually reached a $290 a 52-week high. Now, the analysts were putting crazy numbers on this company in terms of, hey, at the rate it's growing, we expected to do this and this and this, and we all know how that goes if you don't hit your numbers. So from June 2018, it was at 290. Within 6 months, it dropped to $218. Excuse me. Within 6 months, it dropped to $155. That's in December 2018. So it went from 290 all the way down to 218. Now, we're going to ignore this run up here for instructional purposes. From December 2018 to February 2019, it dropped down to $90. So a big revenue missed here. But it was extremely profitable. And we know how people get all bullish on companies that are no longer trending up. So it just started trending sideways, and it moved sideways all the way till May. That's when it announced that, it actually announced back in February that it was going to renegotiate the exclusive rights with United Postal Service. That way it can open it up to other carriers, and there's going to be some short-term growing pains and not as profitable. So people got leery and they just dumped it, and then it went sideways. And then when they announced that and it's going to hurt earnings, and this was out on conference call, it dumped all the way down to $35 a share. So it went from 290 down to 155, down to $90 a share, and then it dumped down to $35 a share just this month. Now, today it is at $43 a share. Now, I want to go over some of the numbers, and after I go over some of the numbers, my personal analytics and research and why I think it's going to do a long-term swing trade dead cat bounce, which I basically, that is my favorite trade and possibly one of my only trades that I put large volumes of dollars into because it's a safe trade with a tight stop loss. Okay, so let's talk about from June 18th at $290, it dropped down to $155. So once again, from 290 down to 155, this basically trended down from here all the way to here. It trended down 46%. But that was a $135 per share loss from 290 down to 155. It lost $135 per share, which it trended down 46%. Now, from December 2018 to February 2019, it dropped down to $90 a share. That's from here, basically, to here, it dropped down 42%. 42%. That's from 155, right? And so it went from 155 down to 90, which is another $65 per share. Now keep in mind, it already dropped 135 per share, and now we drop an additional $65 per share, and this percentage from here to here is 42%. So 46 and 42%. I'll show you the math a little bit here after this next segment. Okay, so from February 2019, when STMP was $90 a share, it dropped. From there, it actually trended sideways. It trended sideways until May, and then from there, it actually dropped down to $35 a share, which is 61% decrease. It went from 90 to $35 a share. That's an additional $55 drop, or 61%. You just can't simply add 61, right, and 42 and 46 and say, wait a minute, that exceeds 100%. You're absolutely correct. It does, because this is a percentage decrease from 46% from 290 down to 155. It's a 46%. And from 155 to 90, it's a 42%. And then from 90 to 35, that's an additional 61%. So at this point, it definitely catches my eye, because the 52-week high was at 290. It's now at the 52-week low, $35. So now it's patience. And today, STMP is at $43 a share. Let me tell you why I went long on this here. And I'll switch to another screen. Hold on. Okay, so quickly I do some quick research and find out why the drops, right? So why the drops? So I pull up the news, and obviously it's got a good reason why analysts get jumpy, because anything that runs up that quick has a severe pullback, right? So I think it ran within 18 months. I think it ran from like $57 up to 290. So I make sure that I hit all the news here. And over here on, I go to the analyst rating, and I make sure that it's a profitable company. Its market cap is $727 million. It's a small cap. Beta, it is kind of volatile. Outstanding shares and total float. But here's where I look at. So institutions like hedge fund managers, retirement plans, and 96% of the institutions hold this stock. and they have about 1,100 employees. They're out of El Segundo. Okay, it's an internet mailing shipping company, I understand. This is the number I really look, the PE. PE is low. The lower the better, the higher. It's overvalued. So that's another thing I look at. And then I quickly jump into the other screen. Okay, I go to finviz.com and I pull up STMP just to look at some of the numbers, right, and to double check and get some different eyes on different things. So I look at the short, the total short, the target price, where they think the target price right now it's 53.40. That's where they think it's going to go. But this is where I look at some of the analysts, right? So this analyst, Northern Capital, went outperform. This was 13, 14, 15, 16. So they had pretty good eyes early on. So I look at Northern Capital. Oh, he downgraded it from outperform to market perform with a price target of 145 to 80. Okay, and that was in May. So he pretty much hit the ball on the head. It's $80. And a lot of these analysts are putting it at 48, 98, 78, which is you know, it is what it is based on, and I make sure that I pay attention to the analysts that hit it right in the past. Sometimes some of these analysts, I think, are kind of like shilling companies or working on the short side in order to downgrade it so they can short it. But if this looks good, then I jump it to the other screen. So this is, I just quickly look and put another mark, 285 in June, and I look at the 3-year trend. And like I was saying, I mean, this thing went from, let's see, go to 5-year trend here. Went down from $50. It ran all the way up to 300. I mean, that's a pretty quick, steep climb within 3 years. That's crazy. And within 1 year, it goes from 285, 290 down to this. So, but the earnings are great. It's got great cash flow. So I go to the ratings again. I go to the ratings. And so the balance sheet, it's positive, income statement's positive, quality, positive, profitability, right? Capital expenditures. I don't give a crap about what the analysts say, right? They're negative on it, just like they were negative on Apple when Apple was 155, just said it's going down under 90. What to do? It climbs back up over 200. And investor sentiment, that's why we're getting such a great deal, because it's negative. So those are the factors. It's still a buy, and everything good about it, and it's still profitable. It's just not going to be gangbusters profitable like they put these crazy expectations on it. So let's see, what else do I earnings, peers, the news, the summaries. Okay, so that's basically it. That's why. Let's go back to the other screen here. Okay, now for the purposes of math, I'm just going to show you a cleaner chart. So, okay, so now I'm going to go over the math. So for the purposes of making this less confusing with all this writing, here's a clean chart for the daily up here. So we're going to focus on this area right here. I'm going to bring it up to the minute chart just so we can see what we're doing here. Let's see. Okay, let's go to the minute chart. Okay, here we go. Okay, so let's zoom it out. See this drop here from 90 down to I think the lowest was 35. So we're just gonna zoom in there. So I wanted to show this. So from 35 to 43, we can safely say that that is $8, correct? Yeah, where is that? Brushes, here we go. So from here to here is $8. Wow, you're saying, wow, $8. Big deal, Gabe. But $8 is no big deal, right? But that $8 signifies a 22% increase. Let's just say you had balls enough to put 100 grand in. That means you'd have 22 grand from there to there. You're talking from 3 days. And all it is an $8 grind. I was like, wow, $8, that's nothing. Because this thing dropped $55 here. This thing dropped $155 here. Right? And then, so $155, and that was a 42%. How can $8 be 22? So $8 equals 22% increase. Now that's amazing. So we're talking from $35 to $43, right? That's right, $43. That's huge. That's absolutely huge. Okay, let's just say that it goes from, say, $35 a share. Let's just say something crazy, and one of the analysts said it was looking at $93 a share. $93 a share is what it's expected to go to and what the company's actually valued. So what is this? Well, if it goes from $35 a share to $93 a share, keep in mind 93 is only 1/3 of the total height that it was at, right? But that is equivalent to 163%. 163%. Wow. Gabe, how is it possible that it moves up $58? $58, yet you make 163% of your money. When this thing went down $135 a share, which is 46%, it went down another $65 a share, and then it went down an additional $55 a share, and all you needed to do is go up $58, and you make 163%. What is that? So if you had the balls to put 100K into it, like I said, at 100 or at $35 a share, your 100K today would be equal to $263,000, and then that basically is just for the stock to get back up to the estimate average. I'm not even talking it if it gets back to $135 a share or $200 a share, $290. I'm just talking it to get back to right before the last drop, which was about $90 a share, which is right here. Anyway, that's all I got, and that's a long-term swing dead cat bounce. Any questions, go ahead and give me a text. I know this was long, drawn-out math, but don't focus on, hey, that's why when you have stop loss, you know, get out of it. Get out of it, and then get back in after it plateaus out. Because remember, you make more going back up because you can buy more shares at a lower cost than it does. Like if you had $100,000 and you rode it all the way down and you said, don't worry, it'll go back up. When it goes back up, you just back even money versus you taking a small loss immediately. It keeps trending down. Don't marry the stock and then get back in, buy more shares, and then even makes half of its climb back up. You're like more than doubled your money. Anyway, that's all I got.